Welcome to the deep dive. We are right now in the middle of this global tech phenomenon that's just impossible to ignore.
It really is. Everyone calls it the AI boom or the AI spring.
Right, and it's a period defined by this almost paradigm-shifting progression. We're talking about generative AI, LLMs, image generators.
Things that are fundamentally changing creativity, but also huge scientific leaps, like Google DeepMind predicting protein folding. This isn't just theory anymore.
No, it's happening right now in real time. And the speed is what's so wild.
The speed is historical. I mean, the groundwork for this, you could say it was laid down between, 2010 and 2016?
Around then, yeah.
But the growth we've seen just in the 2020s, it's become dizzying. The investment, the market value, all of it.
And the adoption. Let's talk about the user footprint for a second.
Well, think about this. As of 2025, ChatGPT is the 5th most visited website on the entire planet.
The 5th. So it's right up there with the absolute behemoths.
Exactly. We're talking Google, YouTube, Facebook, and then ChatGPT. It's not just a successful app anymore. It's become global information infrastructure, and it feels like it was built overnight.
That statistic is the perfect way to frame this because it sets up the central tension we really need to unpack today. The technology is undeniably real. It's transformative. But, and this is the massive financial question hanging over everything.
Is the money real?
Is the financial froth, these staggering, unprecedented valuations, is it all creating the next great stock market collapse? Are we in the dreaded AI bubble?
In defining what a bubble even is, that's crucial here.
Right.
We're not just talking about a slowdown or, a minor correction. A bubble is a theorized event where asset prices, in this case tech stocks, just skyrocket.
Fueled by what? Hype.
Hype, speculation, momentum, this collective feeling that you have to get in now.
Yeah.
And it causes the valuations to become completely disconnected from the actual sustainable profit of these companies.
So our mission for this deep dive is to get you, the listener, right to the heart of the evidence. We're going to unpack the raw numbers, the signs of speculative frenzy that have regulators worried.
And the really unique financial shape this bubble might be taking, it's not the same as 1999.
Not at all. And then we have to weigh the really strong opinions on both sides of this. Is this time truly different?
And that's a key point. This isn't about predicting that the technology will fail. AI is here to stay. It will change the world.
The question is about the price.
Exactly. Is the price the market is paying right now for that transformation rational? Or are we just watching a massive misallocation of capital?
Okay, let's jump right into those raw numbers. Because they are. They're genuinely hard to get your head around. The speed and scale of this market growth, especially in 2025.
It's unparalleled in modern financial history, and you have to start the story in one place.
With the anchor of the whole boom.
The anchor is NVIDIA. You simply cannot discuss the AI financial landscape without focusing on this one company.
Why them specifically?
Because their explosive growth is tied to a non-negotiable scarcity, the world has this overwhelming demand for high-end computer chips, their GPUs specifically.
For chips you need to train the models.
To train the models and then power the massive data centers that run them. And on that critical component, NVIDIA has a near monopoly.
And holding that monopoly translated into market value at a speed I don't think we've ever seen.
Yeah.
Let's talk about the summer and fall of 2025.
The timeline is staggering. So in July 2025, NVIDIA becomes the first company in history to hit a market value of $4 trillion.
$4 trillion. And put that in perspective for us.
Well, that valuation had quadrupled in less than 2 years. It only hit $1 trillion back in 2023.
So this isn't gradual growth. This is a vertical line on a chart.
It's exponential, and they didn't stop there. By October 2025, just a few months later, the company blows past the $5 trillion mark.
Okay, we have to pause on that $5 trillion figure. For most people, myself included, that number is so big it's just abstract.
We have to ground it. That one company's valuation, $5 trillion, is higher than the entire gross domestic product of every single country on Earth.
Wait, say that again?
Except for the US and China. A single chip company is worth more than the entire economic output of Japan, or Germany, or India.
That is it's an unprecedented level of scale and concentration in one single corporation.
Absolutely. And you can see the ripple effect across the entire financial system. If you have a 401k or any kind of index fund, you're exposed to this.
How so?
Well, When the S&P 500 hit its recent all-time high, NVIDIA alone made up roughly 7.3% of that entire index.
One company.
One company. And zoom out even further. AI-related companies accounted for roughly 80% of all the gains in the entire American stock market over 2025.
80%. So 8 out of every $10 of new value created in the market came from this one single theme.
And that is the critical point where you pivot from watching a boom to identifying serious warning signs.
Says it's fragile.
It's inherently fragile. And that fragility, that concentration, is where the alarm bells really start ringing. It's drawing these direct and frankly scary parallels to 1999.
Let's talk about that concentration in late 2025.
It was alarming. The 5 biggest companies in the U.S., all the key AI players, they held up 30% of the S&P 500.
30%.
And if you look globally, those same 5 companies held 20% of the MSCI World Index. I mean, the sources are clear. This is the greatest concentration of market value in half a century.
So you have to go all the way back to the late 60s.
Or the run-up to the dot-com crash.
Yeah.
We have not seen so much riding on so few companies in generations.
Which means if one of them stumbles or even just trembles a little bit, it has these massive cascading consequences for basically every portfolio on the planet.
It's a single point of failure for the whole system, precisely. And it's not just the concentration, it's the financial ratios, the metrics we use to check valuation health. They are all signaling major risk.
So experts are looking at the math and saying valuations are the most stretched since the dot-com bubble. What does that actually mean?
Let's look at a couple of key numbers. First, the S&P 500 was trading at 23 times forward earnings.
Meaning investors were willing to pay $23 for every $1 of profit expected next year.
Exactly. Now compare that to, say, the FTSE index in the UK. That was trading at just 14 times. So the U.S. market is way more expensive, and that premium is almost entirely based on AI optimism.
Okay, 23 seems high, but the truly scary number comes from the long-term historical view, right?
It does. We have to look at something called the Case-Shiller price-to-earnings ratio. It smooths things out over 10 years. And for the U.S. market, that ratio just went above 40.
And why is 40 the magic warning number?
Because the only other time it hit that level was at the absolute peak of the dot-com madness in 1999 and 2000.
Wow, so it suggests investors are pricing in not just growth, but something close to perfection for decades to come.
A level of perfection that history shows is basically impossible to deliver. There is zero room for error, any hiccup, any delay in making money from AI, and you could see a catastrophic re-rating of these stocks.
And speaking of hiccups, let's look at the cost. The sheer amount of money being spent just to keep this engine running.
The costs are mind-boggling, and Microsoft is the perfect case study here.
They've obviously benefited hugely from their stake in OpenAI.
Immensely. But in the 3 months leading up to the end of September 2025, Microsoft revealed it had spent almost $35 billion.
On what?
On AI infrastructure alone. Data centers, chips, cooling systems, power grids, just the cost of staying in the race.
$35 billion.
Yeah.
In 1 quarter. And the market's reaction to that spending, it tells you everything you need to know about this tension.
It absolutely defines it. Because Microsoft's business was healthy, they reported an 18% jump in revenue and a 12% increase in net income.
Those are great numbers.
Great numbers. But their stock dropped 4% in after-hours trading because investors panicked about the cost. They looked at that $35 billion bill and started worrying that the cost to generate these returns is so astronomically high that it's going to eat away all the future profit.
So wait, a company reports incredible double-digit growth, but the market punishes them because they spent too much money investing in that growth.
That's the paradox. That's the fragility right there. Growth is demanded, but the price of that growth is now a major source of fear. It shows the market is getting very nervous about how long this can be sustained.
Okay, so if this is a bubble, it's a very strange one. It's not like 1999, which was all about, retail investors buying dot-coms with no revenue.
No, this seems to be driven by a very unique, very internal financial structure.
So what does it look like from the inside? What are these financial mechanics that have the skeptics so worried?
What's so wild about this whole thing is how anticipated it is. It's like we're all watching it form in real time, and people are calling it out as it happens.
Right. There's that quote from the Australian Financial Review.
Yeah, they said, if we really are in another share market bubble, it's surely the most anticipated example in history.
And it's not just journalists. It's the insiders, the people at the very center of the boom.
Absolutely. Sam Altman, the CEO of OpenAI, he came out in 2025 and said he believes an AI bubble is happening right now.
And Ray Dalio from Bridgewater Associates, one of the biggest hedge funds in the world.
He said the same thing. He noted that the level of investment and just the general exuberance is very similar to what he saw during the dot-com peak.
Then you have Jamie Dimon, CEO of JP Morgan, who gave this huge warning in October 2025. What was his big takeaway?
Dimon was careful. He made the point that the AI technology is real. He's not a denier.
He's not dismissing the innovation.
Not at all. But he immediately followed that up by saying he thinks a lot of the money being invested right now is just going to be wasted, vaporized.
And he sees a higher chance of a big drop in stocks than the market does.
A much higher chance. He thinks there's a huge gap between market confidence, those 40x PE ratios, and the actual underlying risk.
And that skepticism about where the money is going leads us right to this unique financial mechanism, the circular flow, or round-tripping finance. What is that exactly?
It's concerning because it can make revenue look bigger than it actually is. The problem is that a lot of these big AI companies, they aren't consistently profitable. They don't have strong cash flow yet.
So the concern is they're using a kind of financial trick.
Sort of. The theory is that the big AI companies are using these circular deals to basically guarantee revenue for their suppliers, the chip makers, which then boosts the suppliers' valuations. But it's not based on real organic demand from customers.
It sounds like a shell game. You're just moving money from one pocket to the other to make it look like a sale happened.
That's a good analogy. And the biggest example of this came out in September 2025 with NVIDIA and OpenAI.
Walk us through that deal.
So NVIDIA makes a massive $100 billion investment into OpenAI.
Okay, so they're buying a huge stake.
A huge stake. But here's the crucial part. The expectation, according to the reports, was that OpenAI would then take that capital and use it to buy chips from NVIDIA.
So company A, the chip maker, gives $100 billion to company B, the software company. And company B is expected to immediately give that $100 billion right back to company A for its products.
Exactly. It's an instant, guaranteed, massive revenue boost for NVIDIA, which helps justify its sky-high valuation.
But that revenue isn't coming from outside customers paying for a service. It's being funded by the supplier itself.
It creates a self-fulfilling prophecy, and it raises huge questions about the real profitability of OpenAI, which is basically selling off its equity just to buy hardware.
And this isn't a one-off thing.
No, it's widespread. OpenAI also bought billions in chips from AMD, NVIDIA's rival. They have a massive $300 billion deal with Oracle. Then there's Microsoft's huge stake. It's this complex web of cross-financing deals.
Which makes it almost impossible to figure out what the real organic demand for their product actually is.
It makes it incredibly difficult. And this whole structure, this internal financing, this concentration, it makes the next data point the most critical piece of evidence we have.
The one that shows the gap between financial hype and operational reality.
This is the most sobering fact of all, especially for businesses. A report from MIT in August 2025 came out with a bombshell finding.
What did it say?
It said that despite U.S. 3040B abounds in enterprise investment into generative AI, 95% of organizations are getting zero return.
95%. That can't be right.
95%. It means for almost every company that has spent money on these new AI tools, they are seeing no measurable productivity gain, no return on their investment, nothing.
But how is that possible? We know the technology is powerful. Why is it not translating into results for businesses?
Because rolling out AI at scale is incredibly hard. It's easy to write the check. It's very hard to actually integrate it. The report points to a few big hurdles.
Like what?
First, data. A lot of companies just don't have clean, organized data to train the models on. Second, a huge skills gap. They don't have the engineers to actually implement and manage it.
And the third?
The use case gap. They bought it because of the hype, but they still haven't figured out how to use it to actually make money.
So all that money, the 30 to 40 billion, it's being spent on licenses and hardware. It's feeding that circular flow we talked about.
Exactly. But the actual economic value at the other end, for most businesses, it's still years away. And that gap, that time lag, is the huge vulnerability the market seems to be ignoring.
Yeah, and the market is clearly sensitive. We saw that in January 2025 with the launch of that new Chinese chatbot.
DeepSeek, yes, it was unexpectedly good, and the market immediately worried about new competition.
And what happened to NVIDIA's stock?
It dropped 17% in a single day, wiped out billions in value. It recovered a bit the next day, but that massive, reflexive drop shows you how jittery the market is. The current valuations are built on an assumption of total dominance.
And any threat to that dominance can trigger a panic.
A massive panic.
Okay, we have spent a lot of time on the bubble signs. But for a balanced deep dive, we have to look at the other side of this. Not everyone is convinced this is 1999 all over again.
No, and there's a very powerful argument against a crash, and it focuses squarely on corporate fundamentals.
So the argument is that the companies themselves are just healthier this time around.
Fundamentally healthier, more profitable, and just better run than the speculative, cash-burning dot-coms that went bust.
Let's start with Goldman Sachs. How are they justifying these valuations?
Goldman's view is that the high stock prices are actually justified by real, powerful, and sustained profit growth that's already happening.
So it's not just a promise of future profits.
No. They argue that if you actually look at the PE ratios for the big U.S. growth stocks, they're modest compared to what we saw in the dot-com era. I mean, a 40x PE is high, yes, but back in 1999, you had companies with no revenue trading at 100 times. Nothing.
So they're saying the price is high because the technology is proven and it's already generating massive amounts of cash today.
Exactly. And Morgan Stanley backs this up with some really concrete data comparing today's market to 1999. They're essentially saying, don't just look at the high price, look at the quality of the engine under the hood.
And what does their data show? How much healthier are these companies?
It's a huge difference. Morgan Stanley pointed out that the median cash flow for the top 500 U.S. companies is roughly triple what it was in 1999.
Triple. That's a massive difference.
It's a game changer. Cash flow is the lifeblood. It's what lets you reinvest and survive a downturn. And they also have much stronger profit margins. They aren't just chasing growth at any cost. They're profitable while they grow.
And their balance sheets are stronger too.
Yeah.
Less debt.
Significantly. In 99, so many of those companies were burning through cash and loaded with debt. Today, you have giants like Microsoft sitting on mountains of cash. They have a huge buffer to absorb shocks.
And this argument about strong fundamentals is also what we're hearing from the U.S. Federal Reserve, right?
Yes, Fed Chair Jerome Powell weighed in, and he made that same distinction. He said this AI boom is different from past tech bubbles because the companies involved are generating huge amounts of revenue right now.
He's basically siding with Goldman and Morgan Stanley on this.
He is. And he added another interesting point. He said all that spending on infrastructure, that $35 billion for Microsoft, is actually generating a lot of economic growth today.
That's a fascinating counterpoint to Jamie Dimon's view. Dimon sees wasted money. Powell sees economic stimulus.
It's a paradox, isn't it? The investment is real, the construction jobs are real, the chip manufacturing is real. The boom part is grounded in actual economic activity.
The question is whether the stock price reflects the eventual profit from all that activity or just the current excitement over building it.
That's the billion, or rather trillion-dollar question. The counter-argument is basically, yes, prices are high, but the companies are rock solid. If a correction comes, it'll hurt, but it won't be the total wipeout we saw in 2001 because these companies aren't just going to disappear.
But even that strong argument doesn't fully explain away the circular financing or that crippling 95% zero return rate.
No, it doesn't. Those are the specific structural faults that could still trigger a crisis of confidence, no matter how strong the balance sheets are.
So let's synthesize this. If the skeptics are right, if the market's confidence does break, what are the actual consequences? We're hearing some pretty severe warnings from global regulators.
We are, and they're not just worried about tech investors losing money. They're painting a picture of systemic global risk. They're worried about financial stability itself.
Let's start with the Bank of England. They put out a warning in October 2025. What was their specific concern?
They highlighted the growing risk of a global market correction because of the potential overvaluation of these leading firms. They actually called out OpenAI by name.
Why OpenAI?
Because of its explosive growth. Its value more than tripled in 1 year, from around $157 billion to $500 billion. And a lot of that valuation, as we've discussed, was based on those interconnected circular financing deals.
That kind of rapid growth within a closed system is a classic sign of overheating for a regulator.
Absolutely. And the Bank of England identified two main triggers that could cause it all to unravel. First, if the infrastructure costs just prove to be too high to sustain.
The Microsoft problem.
Exactly. And second, maybe more simply, if AI just falls short of the market's sky-high expectations for immediate profit.
They also had a pretty sharp criticism for the investment industry itself, didn't they? About investor risk.
They did. They claimed investors were not being properly cautioned about the risks. Basically, that the whole system, from brokers to analysts, was failing to properly communicate how dangerous this was.
And the International Monetary Fund, the IMF, they seem to be saying the same thing.
They're in lockstep. The IMF's managing director, Kristalina Georgieva, she drew direct and explicit comparisons to the dot-com bust of 2001.
And what's their prediction for the global fallout if the AI bubble bursts?
They predict it would severely stunt global growth. The U.S. market is the engine of the world economy. A sharp downturn there would cause capital to flee, investment to dry up, and supply chains to get disrupted everywhere.
And they specifically pointed to the impact on developing countries.
Which is so often overlooked. The IMF warned that a correction would hit the economies of developing nations the hardest. When the money dries up in New York, emerging markets feel the most acute pain.
It just shows how interconnected and concentrated the risk is. But let's go back to Jamie Dimon for a moment, because he had this great long-term analogy for how these things play out historically.
It's a fantastic analogy. It's both a warning and a source of, well, some consolation. He said an AI crash could cause an immense loss of money.
The generational wealth transfer.
Exactly. But then he put it in context. He said AI will eventually pay off, just like cars in total paid off, and TVs in total paid off.
But most people involved in them didn't do well.
Exactly. That's the key distinction. The technology itself is inevitable and world-changing. But the first wave of investment, the companies and the investors funding this initial phase, might be a total financial bust for most of them.
So the winners might be the companies that come later, who learn from the mistakes of the pioneers.
That's his point. The uncertainty for today's investors should be incredibly high. Even if AI changes the world, the financial outcome for these specific companies, built on circular flows and immense costs, is anything but certain.
So the consequence is a brutal short-term correction that drags down the global economy.
Even while the long-term promise of the technology remains intact. And it all comes back to that paradox of spending without profit.
The 95% zero return rate. If companies keep overpaying for tech that doesn't deliver a return, that funding pipeline has to dry up eventually.
That is the ultimate threat to the circular flow. When businesses finally decide they're not getting value for their money and stop spending, the guaranteed revenue for the chip makers and software developers will crater. That is the true fault line.
This has been a really intensive deep dive into one of the great financial questions of our time. We've talked about the astronomical scale, right? NVIDIA hitting $5 trillion, AI being 80% of market gains.
We've detailed the risks. The highest market concentration in 50 years, valuations at dot-com levels, and this really strange, fragile structure of circular financing.
We heard the warnings from Jamie Dimon, the Bank of England, the IMF, all predicting global instability.
But we also have to remember the strong counter-arguments. Goldman Sachs and Morgan Stanley pointing to robust cash flow, huge existing revenues, and much stronger companies than we had in 1999.
But the critical paradox we just keep coming back to, the thing that should keep investors up at night, is that huge chasm between financial expectation and operational reality.
Absolutely. Just think about the facts. Enterprises have poured $30 to $40 billion into generative AI. And a detailed MIT report finds 95% of them are getting zero return.
So if the whole financial structure is built on these circular investments and massive costs, but the end users aren't actually seeing any profit from it,
how long can the market ignore that gap? The current stock prices are betting on perfect, immediate monetization. But the evidence on the ground suggests monetization is slow, hard, and incredibly expensive.
which leaves us with the ultimate question. Are we watching the necessary, expensive birth of the future, driven by giant companies that are strong enough to absorb these costs?
Or are we just watching the formation of the most over-anticipated market panic in history, built on a speculative timeline that doesn't actually exist? That disparity is the final provocative thought we'll leave you with.
Thank you for joining us for this deep dive.